Hi, today we are going to talk about our new strategy note. This is basically an extension from our earlier episode where we spoke about high government spending and inflation. So what we are highlighting in this report is that we do see from the assessment of the government spending both at the central and the state level that there is a reflationary policy that is in implementation as of now, and there is likelihood of a demand impetus coming from high government spending across multiple sectors. Within the government spending, what we have seen is that the weightage of revenue spending or consumption spending has actually been larger compared to last year, and we have seen that evidence in the fourth quarter FY16 numbers for the Government of India, and also from the various budget allocation for the state governments. So that's number one thing that is actually being corroborated from the data that we have gathered over the past 3-4 months. What we are saying is that along with the higher demand that this will create, there will be a sort of a multiplier effect on the economy by and large. And while that happens, there will be higher inflation is what we are also anticipating. So the retail inflation we believe will actually increase from an average of 4.9% in FY16 to somewhere around 6.5% next year. And as we have mentioned earlier, the WPI inflation would also be rising from -2.5% to 3.5% next year. So clearly, with a higher demand impetus that comes from high government spending, there will be high inflation we anticipate going forward. The implication of this is that there will be a sort of high credit demand that will emanate through the multiplier effect. So for the banking sector, we believe that as the top line growth of companies rise, there will be increase in the transaction demand for money. Resulting from there, the banking sector credit growth will actually increase from something like 9%, and we project it to 13.5% in FY17. That's number one. Number two thing, what we are saying is that as deposit growth lags credit growth, we believe that banking sector will continue to see liquidity deficit going forward, and along with higher inflation, we believe there will be very little scope for RBI to cut rates further. Our analysis also shows that the yield on 10-year GSEC in the secondary market would head higher from the current levels of something like 750. The fair value as per our models is somewhere around 8%, and that is where we see the 10-year yield going forward. And contributing to this would also be the fact that liquidity deficit would further be moved into deficit because of the FCNRB deposits that are coming for redemption between September 2016 to November 2016, and that is in the order of something like $22 billion. So we'll have to watch that as well. In terms of how do one play as an opportunity in the equity markets, what we believe is that because of the reflationary impact of high government spending, it is likely that the consumer goods sector would actually do well, and we have analyzed that over a long period of time, higher inflation scenario would also be accompanied with better performance of the consumer goods sector in general, in particular the durable sector. And within the FMCG sector also, we believe there will be betterment as far as sales growth is concerned. What we also notice is that with respect to the FMCG sector, while the sales growth would improve, we also anticipate that the operating margins for the companies in the FMCG sector would actually come down, and hence the growth in top line will not translate equivalently onto the profit growth. And hence we believe that we have to really look at those companies who have greater buffer as far as A&P to sales growth, sales ratio is concerned, so that as the margin compresses, companies are able to downtrade the ad spend to sales ratio, and thereby protect profit growth or enhance the profit growth. So over there, two stocks that we have highlighted that could benefit are HUL and Imami. Within the durable space, there are most of the durable companies would experience improvement in the top line growth, and where in that case we do believe that the margins will expand because the realization from better products and better demand actually would translate into better performance, even as they allocate more to A&P spend, ad spend. So I think in general, the durable sector would actually do better. What would lower ad spend to sales ratio for consumer companies would imply is that for the media sector, especially those who are into television broadcasting, there will be lower growth in ad revenue. So companies such as Z could actually see a certain deceleration as far as ad revenue is concerned. Moving on, we see implication for the auto sector as well. We believe that higher government consumption spending will have varied impact on the auto sector, and the most positive impact we see is with respect to the tractor segment, followed by two-wheelers and then by four-wheelers. And within that, we believe that company-specific beneficiaries would be Mahindra & Mahindra as a top beneficiary from high government spending, then followed by two-wheelers, within which we see Hero Motors actually doing better, and then in our pecking order, the third one will be Maruti. Within the auto space, we believe the rise in commodity prices would also impair the margins for the auto sector in general. The commodity prices have actually risen. Thereby, we believe that this would translate into increase in raw material to sales ratio, and there are company-specific issues with respect to emission norms and other regulatory issues, and the imposition of MIP to protect the metal sector, that's a measure that the government has taken, would also hurt the margin for the auto sector. Within the banking sector, as I have mentioned earlier, higher inflation and reflationary impact of government spending will also translate into better credit growth, and hence we are positioning our bets in favor of banks who have better unimpaired capital. And then we also look at banks who have better positioning with respect to growth and gaining market share. So essentially, those are banks which have high ratio of retail lending. Then third one, we look at the return ratios over the past several years. We rank companies in order of higher to lower returns, and then and lastly, we give a certain weightage to asset liability gap in the short maturity for the banking sector. In the overall context, we believe that HDFC Bank and IndusInd Bank would be the top pick. Those are well priced, but those will be earning compounding stories going forward. We see value in Yes Bank. After considering all variables, we think that there will be some value also in banks such as ICICI Bank and Axis Bank. Thank you.